Have you ever wondered how stocks can actually pay you money without you ever having to sell them? Well, today we are diving deep into dividends. We're going to break down exactly how owning a tiny piece of a company can mean getting cold, hard cash sent right to your account.
I mean, it's a fantastic question, right? We usually think about making money from stocks in one way: buy low, sell high. But there's this whole other way for your investments to generate income, kind of on autopilot. And by the end of this, you'll know exactly how it all works.
Okay, so let's start at square one, the absolute basics. To make this super clear, we'll kick things off with a simple definition and an analogy that I promise you'll get in about 5 seconds.
So here's the textbook definition. But really, all a dividend is a company sharing its profits. When a business does well and has some extra cash lying around, it can choose to give a piece of that profit back to its owners. And guess what? If you own stock, you're an owner. So that means you.
To really see this in action, let's just forget about Wall Street for a second. Picture this. You helped fund a neighborhood lemonade stand. It has a great week. At the end of the week, the profits get split up between everyone who chipped in. That little payout you get? Yep, that's a dividend. It's the company's way of saying, hey, thanks for being an owner. We had a good run, and here's your cut.
So this brings up a really important question. If dividends are so great, why doesn't every single company pay them? Well, it all comes down to a big strategic choice about what to do with those profits. And we can understand this perfectly with a little pizza shop analogy.
Okay, so a company has two basic choices. It can be like Growth Gus's Pizza. It's new, it's a huge hit, and Gus decides the best thing to do is pour every single penny of profit into opening a second shop, and then a third. The goal isn't cash in your pocket today. It's about building a massive pizza empire for tomorrow. Then you've got Steady Eddy's Pizza. It's been around for 30 years, it's super profitable, and it doesn't really need to expand. So Eddy pays his investors, his owners, a nice cut every single month. This brings in investors who want that consistent, reliable income. See, neither one is wrong. They're just two totally different game plans.
Okay, now we're getting into the details that separate the rookies from the pros. See, you don't get paid just for owning a stock. You have to own it at the right time. And this dividend timeline is absolutely crucial to understand.
So there are 4 dates you need to know. First is the declaration date. That's when the company makes the official announcement. Then there's the record date, which is when the company takes a snapshot of who its official owners are. And of course, the payment date, which is exactly what it sounds like, payday. But the single most important date for you as an investor is that one right there in the middle. And that critical date is the ex-dividend date. Seriously, if you only remember one of these 4 dates, make it this one. It's that important.
Here's the rule, plain and simple. The ex-dividend date is the cutoff. To get that dividend payment, you have to own the stock before this date begins. If you buy the stock on or after the ex-dividend date, the person who sold it to you gets the dividend, not you. Just think of it like this. X means without. On that day, the stock starts trading without the right to that upcoming dividend payment.
All right, let's talk about the practical side of things, the numbers investors actually use. How do you compare different dividend stocks? And how can you use these little payments to build some serious wealth over time? Well, it all comes down to understanding 2 things: yields and snowballs.
Okay, the most common way to compare dividend stocks is by looking at the dividend yield. The easiest way to think about it is like the interest rate on a savings account. It's not about the raw dollar amount they pay, it's about the percentage of income you get back compared to the stock's price. And you calculate it just by dividing the annual dividend per share by the price of 1 share.
And this little comparison shows you exactly why yield is so important. Stock A pays a bigger dividend, right? $4. But since it's a $100 stock, its yield is only 4%. Now look at stock B. It only pays $2, but since the stock only costs $20, its yield is a whopping 10%. So which one is the better income investment? Just looking at the yield, it's stock B, no question. It's all about the bang for your buck.
This famous quote introduces one of the most powerful forces in all of finance: compounding. And you know what? It's a force that can be powered directly by dividends. So what happens when you take that cash you get and immediately put it back to work?
Well, that is the magic of something called a dividend reinvestment plan, or DRIP for short. It's so simple but so powerful. Your broker just takes the cash from the dividend and automatically buys more shares of that same stock for you, so the next time a dividend is paid, you get paid on your original shares plus your new ones. That bigger dividend then buys even more shares, which pays an even bigger dividend next time.
It's literally a snowball of wealth rolling downhill, getting bigger and faster all on its own. This is the engine of compounding.
All right, we've covered what dividends are, why companies pay them, and how you can use them to your advantage. But there is one final, really crucial piece of this puzzle that every single investor needs to know about. Let's just call it the catch.
So this is the question you got to ask yourself. Since dividends are basically income, just like your paycheck, it kind of makes sense to wonder, does the government want its cut?
And the answer is a big, clear yes. You have to remember, dividends are taxable income. And here's the part that catches so many people off guard. You owe taxes on them even if you automatically reinvest them in a drip. In the eyes of the government, you got the cash first, and then you chose to buy more stock with it.
But there is some good news here. Not all dividends are taxed the same way. Ordinary dividends get taxed at your normal, higher income tax rate. But qualified dividends are taxed at the much lower capital gains rate. And the best part? For most long-term investors, your dividends will become qualified just by holding the stock for more than 60 days. That's a huge tax advantage.
So let's wrap this up with a quick summary of our dividend playbook. Number 1, dividends are real cash paid to you from a company's profits. 2, they're often a sign of a stable, mature business. 3, they can be a fantastic stream of passive income. And maybe most importantly, reinvesting them is the fuel that powers that incredible compounding engine.
And that really brings us to the final question, which is for you. Now that you know the playbook, how is this going to fit into your own investing strategy? Are you going to be hunting for those growth guzz companies, aiming for that explosive future value? Or are you looking for the steady Eddy companies that provide reliable income today? Or, maybe a little bit of both. The choice is yours.